Now our webinar is on demystifying banking. Let's understand the contents. What we are going to discuss today is the concept of why do we need banks, types of banks, functions of a commercial bank, banking business lines, why banks are supervised, how banks are supervised, important regulatory ratios, and types of banking products. As I said, and I'll repeat, that this is the first in the series, and we'll be having many more such webinars by taking the same concepts which we are discussing today forward and expanding them. So this is where we begin on our webinar. So let's begin the discussion on our first slide, and that is understanding why do we need banks. Now there are many reasons of having a banking system, and typically across the globe banks offer different products. In fact, banks and banking have been around for a very long time, and banks do play a key role in the modern economy. Now there may be different products available, but there is a variation of products across different banks and across different regions. But typically the banks offer three major services, and those three major services are the deposit collection, the payment services, and disbursing loans or giving loans. These are the three basic services which a bank will give. Now when we have got these three services, now we will be able to look at the slide, and I got the first point which says financial intermediation. So let's first understand what is financial intermediation. All of us know that there are people who would have surplus money because they earn more than what they need. And on the other hand, there could be other category of people or customers who earn less than what they need. So there are people who are having surplus money, and there are people who are in need of some surplus money. And that is where the process of financial intermediation will come in place. So when a bank accepts deposits, the depositor is actually lending money to the bank. And in exchange, of course, the depositor gets interest, and at the end of the maturity, he gets his principal back. So the bank is receiving deposits from different people or different customers who have got surplus money, and these customers get interest from the bank. At the same time, bank also has borrowers who need this money, so the bank would be lending money to these borrowers and earning interest for them. So when the bank does financial intermediation, what it is actually doing is accepting deposits and lending money, and it is bringing on a single platform two different categories of customers. One category of customer who has money, and the other category of customer who needs that money. And this process of bringing two parties together is known as the financial intermediation. So in financial intermediation, the typical role is to bring two parties together, one who has got extra money and one who needs that extra money. So this is simply how we will define financial intermediation. But then there are issues involved in this financial intermediation. Let's understand those issues one by one on this particular slide. Now the first thing is the asset transformation. Now what does this asset transformation mean? We will have two types of assets when we operate across countries, and in fact everybody has got two different types of asset. One asset is a real asset, and another asset is a financial asset. Now let's understand what a real asset is. A real asset is an asset like, let's say, building or machinery or land or your cars are real assets. They exist in reality. On the other side, we'll have financial assets, that is like money. You may have deposits, you may have insurance, you may have equity shares, you may have bonds or debentures. So we will have two categories of assets. One is a real asset and another is a financial asset. Now when somebody needs a real asset, for example, you want to buy a car. To buy a car, you need money, and money is a financial asset. So to buy a car, we need money. The bank will provide us the money, and using this money, the loan, we will convert that loan, a financial asset, into a real asset like a car. So bank enables us to convert from a financial asset to a real asset, and from a real asset, for example, somebody sells his car, he gets the money. So the bank is enabling him to sell the car and get the money. So we will have asset transformation, that is converting from real to financial asset, and from financial asset to real asset. This is how a bank will enable somebody to carry out the asset transformation. Now when we have got this asset transformation, we can also look at it in a different way. Some people will have deposits, that is financial asset. That deposit, a financial asset, is converted into a loan through a bank. So deposit gets converted, so we are converting one kind of asset into another kind of asset. That's why financial transformation would be done by a bank, and that's why we need a bank. Let's look at the second point, that is mismatch transformation. I am a person who wants to deposit money in a bank for a period of 5 years. But there may be another customer on the other side, like Constantina, who wants that money as a home loan for 15 years. So my need is to deposit money for 5 years, but her need is to take a loan for a period of 15 years. And therefore there is a mismatch in the maturity of the transaction. My requirement is of 5 years, her requirement is of 15 years. This mismatch is handled by the bank. So when somebody like Constantina applies for a loan of 15 years, the bank will use my money for a period of 5 years and lend that money to Constantina as a home loan. And at the end of 5th year, it will take money from somebody else and repay my own deposit. So whenever there is a mismatch in the maturities of the deposits vis-a-vis the maturity of the loan amount, the banks handle these mismatches in the maturity. Therefore, for managing the maturity mismatches, we need a bank. Another mismatch could be there in respect of amounts. I want to deposit $10,000, but somebody wants a loan of $15,000. So bank will take my $10,000, somebody else's $5,000, and then give this loan to the borrower. So the banks will handle two types of mismatches. One is a mismatch on account of the transaction value, and two is the mismatch on account of the time period involved in the transaction. So this is where the banks again come into picture, that they will handle the mismatch in the value and the mismatch in the time period. The next point is risk transformation. Now what does this mean? This means that when a depositor gives the money to the bank assures him that his deposit would be repaid on the given time. At the same time, however, the bank is absorbing this risk that the borrower, if the borrower does not repay the loan, we will still repay the depositor. So far as the risk transformation is concerned, the bank is absorbing this risk that the borrower doesn't repay the loan in time. Despite the borrower's failure to repay the loan in time, the bank will repay the depositor in time, and thereby the risk of non-payment by the borrower is absorbed by the bank. This risk is not normally transferred by the bank to the depositor. So this is where the bank is enabling the transformation of risk from the borrower to the depositor. It is absorbing that risk. And as we said earlier, the banks provide payment services, and in payment services they act as a fuel pump to the economy. And in most of the places you'll find that the banks will be moving money across the cities, across countries, and the businesses would be utilizing the banks in order to move the money from one place to another place. And one more point which is not there on the slide is money creation, but then we'll discuss this point of money creation a little later. So this is where we'll understand, or we have understood, why do we need a bank. Now before I move to the next slide, do you have any questions on whatever we have discussed till now? Okay, so I presume that we are clear on this point. Now let's move forward to the next point. And that next point is talking about different types of banks. Now on your screen, you will be able to look at the regulator and the supervisor. You will be able to look at central bank and the commercial bank. Now let me explain all these three concepts to you. The first concept is regulator and supervisor. Let me explain the difference between regulation and supervision before we move forward. Now, for example, in United States, you will have the Federal Reserve Board, or the Federal Reserve System as the regulator or the supervisor of the banking system, whose logo you see on the slide. In UK, you will have the Financial Conduct Authority as the supervisor. You also have the Prudential Regulation Authority as the supervisor. And in India, we have the Reserve Bank of India playing the role of the supervisor. So what is the difference between a regulator and a supervisor? Let me explain the difference to you. Regulation will refer to a set of rules and laws applicable to banking. So there will be somebody who will be defining the laws, the regulation to be followed. And nowadays, with the globalization of the entire world, the regulation gets defined across different countries. So we will talk a little later about the Bank for International Settlements. The Bank for International Settlements will lay down the regulation or put guidelines as to how the banks should be regulated, and the supervisory authorities in each country, in Basel they call it as national supervisor, the national supervisor of each of the countries will implement that in their regime. So regulation will refer to a set of rules and laws applicable to banking, which now could be decided globally, and they would be implemented in a country through the national supervisor. Therefore, supervision can be defined as the monitoring by the authorities like the Federal Reserve or by the Prudential Regulation Authority. They monitor the activities of the banks and they enforce the regulation. So the difference between a regulator and a supervisor would be a regulator will define the rules and the supervisor will ensure that those defined rules are being followed by the banks in their particular country or their particular regime. The second category of the bank is a central bank. Now what does this mean? A central bank plays two major roles. And the first major role, it is a banker to the government. For example, the Federal Reserve is the banker to the government of United States, or the Reserve Bank of India is the banker to the government of India. So the first role a central bank plays is the banker to the government. The second role it plays is it is the banker to the bankers. So for example, there may be many banks like Citibank or HSBC or American Express having their accounts, bank accounts held at the Federal Reserve Banks. Or there may be a bank like HSBC in Hong Kong having its account with the Hong Kong Monetary Authority. So the central bank plays two major roles, as we said just now, is one banker to the government and the banker to the banks. It can also play a role of the issuer of currency. For example, in United States, the Fed will issue the US dollar hard currency. In Hong Kong, we may have the Hong Kong Monetary Authority issuing the currency. In India, we'll have the Reserve Bank of India issuing the currency. So the third major role a central bank plays is issuing the currency in their respective countries. And in some countries like Hong Kong, the role may be outsourced. For example, in Hong Kong, in addition to the HKMA, the Hong Kong Monetary Authority, the other banks like HSBC and Standard Chartered are also allowed to issue currency notes on behalf of the Hong Kong Monetary Authority, that is the central bank. So this is where we'll have the third role of central bank. The central bank also plays the role of monitoring the monetary policy or operating the monetary policy. In fact, there are two policies. I'll not go in detail into those. There could be a fiscal policy operated by the government, and there could be a monetary policy to be operated by the central banks. So central bank will have these different types of roles. And then we will have the commercial banks. Commercial banks examples could be Citibank, Barclays, or State Bank of India, or maybe some bank like American Express. So we will categorize the banks at a very, very broad level into a central bank and a commercial bank. Now when we have got these banks in place, the commercial banks can be further classified by ownership. Now I am taking an Indian example and we will also discuss the examples in other countries. Now by ownership in India, a commercial bank can be defined as a public sector bank. For example, the State Bank of India is a bank owned partially by the government of India. More than 51% of its ownership is with the Reserve Bank, with the government of India. Or we could have a private sector bank like Citibank or Barclays, or in India we have got the ICICI Bank. So we'll have private sector banks where the ownership is mainly with general public. And the third category would be a cooperative bank where members come together, people come together, they form a bank, and then this bank is used to accept deposits and then also to lend money to others. So there will be three categories if you go by the ownership: the public sector bank, a private sector bank, and a cooperative bank. Also, if you look at the categories, we can categorize them by incorporation. That is, where have these banks been incorporated? Where are they born? Where do they belong to? For example, Citibank is a domestic bank so far as United States is concerned. But when some other bank like HSBC operates in United States, it would be classified as a foreign bank. So you could have foreign banks which are regional smaller banks, or you could also talk about international or global banks like Citi or American Express. So these are basic categories of banks where we have three categories which we have discussed till now. One is the regulator and the supervisor, then the central bank, and then the third one is the commercial bank. And in the commercial banks we looked at the two types or two classifications, one by ownership and the another one is by incorporation. So this is where we have discussed varieties of banks. Now let me again ask you this point, or do you have any question at this point? Is RBI a regulator or a supervisor? Can you explain, is the question from Arijit. Yeah, let me answer this question, Arijit. RBI currently plays a role partially of regulator and partially of supervisor. But over a period, the Reserve Bank of India is also expected to play a role of supervisor, because we will be now having across the globe standard regulation. Like you have got these ISO standards, banking sector would also start having their basic standards which are issued across the globe, and they'll be adapted to meet a situation in every country. So Arijit, currently RBI is in the transitionary mode. It is partially the regulator, partially the supervisor. If you remember, earlier the Reserve Bank of India was even defining the rates of interest which the banks should charge on deposits and on loans. Nowadays gradually they are reducing their exposure in that area. So regulation is getting out and supervision is coming in. Arijit, are we clear on this point? Now Anushri, which last point is not clear? Can you tell me once again? In the meanwhile, I'll talk about global regulator. Arijit, there is no global regulator as such, but we have a bank called Bank for International Settlements, where most of the countries in the world are members. These members come together and draft regulations which would be once accepted, which would be implemented across the globe. So we do not have a single regulator, but we have a body called Bank for International Settlement, popularly known as the Basel Committee on Banking Supervision. So BCBS plays the role of a guide to the regulating authority, and those rules or regulations are implemented across the globe. Now in this case, the World Bank doesn't play a role. World Bank is in fact a funding body. The World Bank is a body which collects money from mainly the developed countries and lends that money in developing countries or underdeveloped countries, so that the other countries which need the money can go on improving their economies. So that is the role of the central bank. That is the role of the World Bank. Now let me answer this question from Murli. Now Murli, the commercial bank is a bank whose sole objective is to make money by lending money or investing the money. So they would accept deposits on which they will pay interest, and they will lend this money or invest this money and then get return out of that. The role of commercial banks is profit making by carrying out this lending activity and deposit taking activity. Now Sangeeta has a question asking what is the difference between a foreign bank and an international bank. if you look at it from regulation perspective, Sangeeta, there is no real difference between foreign bank and an international bank. I have classified it for the session only as foreign bank and international bank. If you look at it from legal angle, both of them are one. Now let me explain my version of what is foreign and what is international bank. A foreign bank is a bank which is not having a global presence, maybe a small bank having a couple of branches across the world. But an international bank, example could be Barclays or Citi or American Express or HSBC, which are present across the globe. So I'll repeat, from regulation perspective, we do not differentiate between foreign and international. We'll have only two categories, domestic and foreign. Now I'll answer the next question from Anushri, which is on fuel pump to the economy. As I said earlier, the banks play a role of moving money from one place, one location to another location. And all businesses, all economies run on money. So the businesses as well as the governments should be able to move money from one place to another place. That is one way it can act as a fuel pump. And secondly, all businesses need money for operational purposes. Banks are the major lenders to the businesses so that they start operating and running. And from that perspective, Anushri, I was talking about the fuel pump to economy, that it provides the necessary fuel for operations of business and through which the economy would be operating. Are we all clear up to this point? Okay, Devendra's question I have not answered. Let me go ahead. In which category bank will fall? Devendra, there is one category called multilateral development banks, MDBs. Now, an example of a multilateral development bank would be an Asian development bank or an African development bank. The role of these banks are similar to a World Bank, but these are region specific. So when we will have these BRICS banks in future, the role of BRICS bank will be identical to a multilateral development bank, the MDB. Take money from those governments or those countries which have got surplus and give it to those countries which will be needing that money. That is the role of the BRICS bank, which is expected to be there for 5 nations. Are we now all clear on this point so that I can move to the next slide? So now let's discuss our next point. Let me go out of this camera so that the bandwidth is not consumed unnecessarily. Now we want to talk about different types of banks, and this is within the commercial banks. And we said that commercial banks are involved mainly in making profits. Their major role is to make profits. So let's understand different types of banks from that perspective. Now when we have got banks, I can talk about the first category, that is retail banking. Now all of us understand that retail would mean we have small value of money involved in the transaction. So we'll be accepting money from small customers and giving that money to small customers. So in retail banks, I can create categories, or we can have categories like retail and consumer banks, private banks, postal banks, building societies and credit unions. Let me explain each of these now to all of you. Now when we have got these retail banks, the primary customers will be individuals, or you can call them consumers. Many retail banks also offer services to small and medium enterprises. So retail does not necessarily mean banking only with individual customers. It could be even the SMEs, the small and medium enterprises. And then these retail banks may have particular specializations. And depending on the specialization, we have got these subcategories like retail and consumers, private and postal, etc., etc. Now let's discuss the first one, that is retail and a consumer bank. Retail banks or consumer banks, you could also talk about saving companies, loan companies, thrifts, etc. These banks offer loans primarily to individual customers. And the kind of loans or deposits they have, loans they could have, example could be a car loan, a home loan, maybe a personal loan. So their focus is on a retail customer, and they'll be operating only in this line of business where retail small customer is serviced. They accept small deposits, they give small loans. And examples of such a bank could be a Woodland Bank in USA, or maybe a bank like the AIG Retail Bank in Thailand. So there could be banks focused purely on a retail consumer who could be individual or who could be an SME, that is small and medium enterprises. On the other hand, we can have private banks, and on the screen you can see a couple of examples, logos of private banks like the Courts, or you can have an example of the HSBC private bank, or you can also have the example of the G. Horan Company in UK. So Courts and Horan Company are the examples of private banks from the UK, and HSBC is also a bank based out of UK. Now what does this private bank do? The private banks are like retail banks only, but the difference is, while retail banking is for mass customers, private banking is for class customers. And what do we mean by class customers? Class customers mean you will have high net worth individuals or ultra high net worth individuals. So you'll have somebody which is very rich, ultra rich. For them, there may be separate banks which are created, and they will service only those high net worth and ultra high net worth individuals. And some of the banks may even service affluent customers. So we will categorize them like this, that ultra high net worth individual, which is the richest character, richest person, richest customer, maybe somebody like you have the Bill Gates from Microsoft. Then you could have a high net worth individual, HNI, and then you will have an affluent, and then below the affluent you will have the normal retail customer like me who is not very rich. So for me, I could have a retail banker, but those who are rich, like somebody like Queen of England, she banks with the Courts, whose logo you see on the right and top of our screen. In fact, Courts and Company has been formed in 1692, and they have been bankers to the Queen since then. Currently, Courts is owned by the Royal Bank of Scotland, and they are Queen's bankers. So private banks' role is giving loans and services to typically rich individual customers. And there is a concept of foreign family offices also in the private banks. What does family office mean? I'll take an example again from the Queen of England. In Queen of England's family, there could be various individual members of the family who are on their own also very rich. A private bank like Courts can have an individual officer assigned to each of these individual members of the family, and through the family offices, the banking requirements of each and every individual is taken care of. And when we talk about private banking would give you deposit products and loan products. In addition to that, it could have multiple other types of products which are created specifically for the rich customer. So let me now summarize by telling you the difference between a retail bank and a private bank. Retail bank is for masses, private bank is for classes. Retail bank will have standardized products, and private banks will have customized products for rich customers. The third category we have is the postal banks. Now the postal banks offer banking services to customers through post offices. In many countries there are postal banks. For example, in Germany there is a bank called Post Bank, or in Japan there is a bank called Japan Post Bank. In India we have got the post offices who also offer the banking services. Or in Sri Lanka we have a bank called National Savings Bank. This is part of the postal banking system. So a post office also operates like a bank, then we call it as a postal bank. And the last one is the building societies and the credit unions. Especially these exist in Europe, mainly in the UK, where initially these institutions like building societies were created for the purposes of lending money for mortgages, home loans, and now they carry out all the different types of banking activity. So this is where we understand what is known as the retail banking. Now before we move further from retail banking, do you have any question on the retail banking? Yes, Samir, a person can use a private as well as a retail bank. In fact, a retail bank is available to everybody, but private banks have certain norms of accepting a customer. So unless a customer is very rich, the private banker will not accept him as a customer, and many banks, especially in the United States and Europe, have specified norms of what would they call as a customer eligible for private banking. So private banking is possible only for rich and ultra rich customers. Retail banking, of course, available to everybody. So private banking customer may be able to use a retail bank, but it may not happen the other way around. A retail banking customer may not be allowed to use private banking if it does not fit into the norms of a private banking customer. Now let me tell you, Srinivasan has a question. A custom product, what is a custom product for a private bank? Let me explain this point. Now, many a times people would like to invest in antiques or paintings, or there may be rich customers wanting to buy palaces or yachts. In this case, banks, while lending money to buy a painting or to buy an antique piece, would provide advisory services to the customer as to which kind of painting or which kind of antique piece will give him the maximum return. So when they invest or take loans for buying a painting or an antique piece, the bank would provide them not only the advisory service of identifying which would be the best buy for him, they'll also lend money. So this is one custom product where for buying a particular item they will give a service. Second example could be, we will have different age groups to which these rich customers belong. Depending upon age group, the private bank will create specific portfolios or specific investment patterns, specific services like writing wills or managing their inheritance. These are the services which private banks will give to the rich customers. These services, for example, I can't think of buying a painting, but if I were to buy a painting, the bank will neither lend money to me nor will it provide advisory services. So while investing or getting loans for items like yachts or paintings or horses or antique pieces, the banks will go all the way across to provide the entire service to a customer. This is one example, Srinivasan, of what can a private bank provide to the customers. Srinivasan, are we clear? Good. So now we have discussed this point about the private and a retail bank. Let's now move to the wholesale banking. Now when we talk about wholesale banking, we can talk about commercial banks and investment banks. What is a commercial bank? A commercial bank is the one which is lending money. So the basic objective of a commercial bank, accept deposits and lend money. And the basic objective of an investment bank is to provide fee-based advisory services. So you may have heard of a commercial bank like Citi or a Barclays, and you may have heard of investment banks like Lehman Brothers or maybe Goldman Sachs. The role of Lehman Brothers or Goldman Sachs is not to actually lend or borrow money. The role is to advise somebody on what to buy, when to buy. So there could be an investment bank which is involved mainly in the fee-based services, which one of the services could be advising them. So another example of that could be mergers and acquisitions or marketing an IPO. All these kinds of activities would be done by an investment bank. So a commercial bank's major source of income would be interest on the loans given, whereas the investment bank's major source of income would be fees received on the basis of advisory services. This is where we will have the difference between the commercial banks and the investment banks. Now let's move to the next point, and that is understanding what is universal banking and what is narrow banking. Now when we have got this universal banking, it means the bank can give all types of services. It accepts deposits, it lends money, it invests money, and it provides a couple of other services like maybe payments and remittances or maybe letters of credit, bank guarantees. Different products are provided by the universal bank. So it is doing both the activities, both basic activities, that is accept deposits and lend money, and it may be lending money by taking extra risk. As against this concept of universal banking, we have the concept of narrow banking or safe banking. In narrow banking concept, the banks will only be accepting deposits, and when they lend money, they'll be lending it in a very, very safe way. They'll not be lending it by taking extra risks, or they may be investing this money in very high return, or rather high safety bank or government investments. So narrow bank is where deposit acceptance will be happening, but the lending process will not be as risky as a universal bank. A universal bank may take more risk, whereas a narrow or a safe bank will take lesser risk. And you could have examples where the banks would not be willing to take extra risk in respect of such products like investing in derivatives or investing in equity shares. A safe bank or a narrow bank will mainly be looking at very, very safe modes of investment, and therefore the returns from a narrow bank or a safe bank to the depositor are going to be a little less as compared with the other banks. So this is where we'll have the classification, where universal banking means do all kinds of banking activity, and narrow banking would mean do only those activities. Rather, accepting deposits will be done by both of them, but in narrow banking we will do only activity of lending money in a very, very safe way. That is the difference between the universal banking and the narrow banking. Now at this point, do you have any questions? Okay, there are a couple of questions which are below. Let me explain them. Now, one question is IDBI comes under which category? So I would put IDBI is a commercial bank. Earlier, Shailesh, this question is mainly from Shailesh. Shailesh, IDBI was earlier a development financial institution. In India, it was known as the Industrial Development Bank of India. There were two main development financial institutions in India. The ICICI, which is the Industrial Credit and Investment Corporation of India, ICICI, and the Industrial Development Bank of India. Both of these are institutions created by passing a special law in the parliament, and these were development financial institutions. That means their role was limited to lending money for infrastructure project. Later on, both the entities, IDBI and ICICI, converted themselves from a development financial institution into a commercial bank. That's why we now have IDBI Bank and ICICI Bank. So subsequent to the conversion, they now have become commercial banks, but earlier role was a DFI, a development financial institution. Now let's proceed to the next point and understand the functions of a commercial bank. Now, commercial bank has three basic activities, as we said earlier also, and I will divide them now into the primary functions and the secondary functions. In the primary functions, we will have deposits, and under deposits we will have demand deposits and the time deposits. Now an example of a demand deposit could be a current account or a checking account and also a saving account. So any deposit which is repayable to the customer on demand will fall under the category of a demand deposit, whereas a deposit which is repayable to the customer on maturity of some time period, like let's say a 1-year deposit, then that would fall under the category of a time deposit. So the bank will get its money mainly from the deposits. So the source of money which a bank typically has is the deposits which are taken from customers. Sometimes they do take money by purchasing these money from other banks. So they could be short-term funds which are known in the banking parlance as purchased funds. So we could have two types of sources of funds for the bank. One is the deposits and second is the purchased funds. Purchased funds are typically temporary loans, temporary deposits taken from other banks or other institutions, and normally the demand deposits and time deposits will be the core deposits in a bank. Another primary function of a bank is to make loans and also make investments. And like we have in deposits, we have demand deposits and time deposits. Similarly, we'll have demand loans which are repayable to the bank on demand and term loans. An example of a demand loan which you can have is an overdraft from the bank. And an example of a term loan which you can have is the home loan or a car loan which you take from a bank. So primary functions of a bank will involve accepting deposits and lending that money or investing that money. It also has the secondary functions. The secondary functions are agency functions or other services. Let's look at a couple of them. Now there could be a collections and remittances service where the bank plays a role of an agent and collects money on behalf of the customers. It pays money, remits money on behalf of the customers. There could be products like letters of credit, trade finance products like letter of credit or bank guarantees. There could be products like derivatives where we can have a forward contract or a swap being sold by the bank. So the banks would typically carry these primary and secondary functions. I would classify all these into FAAR. Now what is this FAAR? It is finance, assurance, agency and risk management. So when a bank gives a loan, it is financing the customer. It is lending money to the customer. In an assurance product, the bank is assuring somebody that if there is a problem, the bank will resolve the problem. And an example of an assurance product on the screen is a letter of credit. When a bank issues a letter of credit, it is assuring the seller that it will definitely make the payment provided the seller complies with the requirements of the buyer. So this is one example of an assurance product. A bank guarantee and letters of credit are examples of assurance products. The third kind of service is agency. The bank acts an agent of the customer. Let's take an example. Sometimes in India as well as in other countries, we deposit taxes with the banks. The bank then is acting as an agent of the government and then collecting those taxes. Or sometimes we pay our magazine subscriptions, membership fees or even insurance premiums through the banks. Then the bank is acting as an agent of the insurance company when it collects the money. So we will have agency services provided by the bank. And the last one is the risk management service. Example of that is a derivative like a forward transaction. When an exporter exports goods abroad, there is a chance that he may lose some money because of exchange rate variation. There could be a loss on account of exchange rate variation. In order to protect this exporter customer from exchange rate related losses, the bank can offer a product like a forward contract. Now in our subsequent webinars, we will be discussing all these different types of services and products, but this is where I am introducing these services to you. So I will now summarize on this slide by saying that we could have a finance product, we could have an assurance product, an agency product and a risk management product, so far as a bank is concerned. Now let's move to the next point of what kind of products the bank can offer and the banking business lines. Now in the banking system, I did talk about something called the Basel Committee on Banking Supervision, BCBS. It divides the entire banking system. It has classified the entire bank's system into 8 different business lines, starting with the first one is the corporate finance. The second one is trading and sales. The third is retail banking. Fourth is commercial banking. Fifth is agency service. Sixth is asset and wealth management. Seventh is payments and remittances. And the eighth is retail brokerage. So under the Basel Accord, for operational risk purposes, the business lines of a bank have been divided into these 8 categories: corporate finance, trading, sales, retail banking, commercial banking, agency, etc., etc. Let me explain these one by one in a brief way. Corporate finance is where we give advisory services to a corporate, and this is where the bank will be earning by way of fees. An example of corporate services could be mergers and acquisitions. A customer of a bank wants to acquire some company, some business. It will appoint a bank to identify which company can be taken over by this customer. Or alternatively, a customer of a bank wants to sell one of his companies or one of its divisions. It will appoint a bank to identify a customer, identify another party who would be willing to purchase this division from a company customer. So corporate finance would basically mean providing the fee-based services. One more example of corporate finance could be the loan syndication. The banks would provide services wherein the corporate customers would be in the position to get more money from the market without taking it directly from the bank. For example, Citibank may provide a service to a company like maybe Indian Oil to get funds from the market, maybe by way of equity shares or maybe by way of raising loans from the market. This service is provided by Citibank to Indian Oil by charging them fees. So under corporate finance, to summarize, services would be provided by the bank to the customer by charging them fees. In corporate finance, we are not lending money to the corporate. The second point is trading and sales. In trading and sales, we will be buying and selling investments. So basically it's the treasury. Popularly, trading and sales is mainly the treasury of the bank. So herein, we'll have two basic divisions in a treasury. One is a domestic treasury dealing in domestic markets like domestic currency and domestic equity shares, domestic bonds, etc., etc. And we'll have a forex treasury. In a forex treasury, we'll be carrying out mainly the foreign exchange related transactions. Buying and selling currencies, buying and selling investments in foreign currencies is what the forex treasury would be doing. So under trading and sales, there will be typically activities of trading in investments, trading in exchange, trading in gold, which is known as bullion trading. So you'll have bullion trading happening in the trading and sales services. Retail banking, as we said, is meant for small customers, but you could have a different small definition of retail banking under Basel. Basel says, or the Basel Accord states, that any exposure which is of 1 million euros or less can also be classified as retail banking. But then our normal definition of retail banking is that we have products like home loan or auto loans or credit cards or saving bank accounts are all our examples of retail banking. Commercial banking is where we lend money to corporate customers. So commercial banking is the way in which bank would lend money to a large customer and earn interest out of that. Now let me differentiate here once again between corporate finance and commercial banking. Corporate finance is giving services to the corporate and charging him fees. Commercial banking is lending money to a corporate and charging him interest. That is where we will have the difference between corporate and the commercial banking. The next point is agency services. And as we said earlier also, the banks will act as an agent. Many banks sell third-party products like insurance products or mutual funds. In that case, a bank is acting like an agent of that mutual fund or that insurance company. Then we'll have asset and wealth management, which is popularly known as private banking, which we discussed a little while ago. Under payments and remittances, we will be remitting money or receiving money on behalf of the customer. So the RTGS payment system, the real-time gross settlement systems, or somebody like Fedwire or CHIPS or Target 2 in Europe, the single euro payment area, are all connected with the payment and remittances service, where the banks are involved in moving money from one end to another end. And the last one is the retail brokerages. In retail brokerage, the banks will act as brokers for small customers like me. So in that case, in this way, we'll have the 8 basic banking business lines. Now it's not necessary that all the banks will have all the business lines. Some banks may have all, some banks may operate only with some limited number of business lines. So this is where we have the different types of business lines. Now I'm moving to the next slide. Before that, do you have any question? Okay, now there are a couple of questions on the screen. Let me, now somebody is asking about what is a wholesale. Amit Kedial says, what is a wholesale bank? Now wholesale banks carry out business for corporate customers. So the corporate banking divisions where the banks do business only with corporates is an example of the wholesale bank. Then we will have this example, there is another question, an example of a narrow bank from Pranjali. The Pranjali, you can take an example of the postal bank in India, the post offices. When you go to a post office in India, you can deposit money in a saving account, you can deposit money in a recurring deposit account, you can deposit money by way of a fixed deposit, a term deposit, but you can't take a loan from the post office in India. So an example of a narrow bank could be a post office. Post office only accepts deposit. The post office does not lend money. That's how you can look at this fact, that it does only one activity of acceptance of deposit. It is actually the borrowing of the government. Now an example of retail brokerage, Pratik. Pratik, in India we have got entities like ICICI Direct, and we have got entities like Kotak. Now before I say this, let me tell you one point, that in India, or in many countries for that matter, retail brokerage is not permitted to banks. So in India you will not find a bank which is a broker, which is a member of a stock exchange. And therefore banks in India like ICICI Bank or Kotak Bank have created separate companies like ICICI Direct, which is an independent company, or Kotak Securities, which is an independent company, which will act as a brokering company, broking arm of that division. But in countries in Europe, it is allowed for a bank to become a member of the stock exchange. Then if they do business for a retail customer, that would be the concept of retail brokerage, Pratik. Now Ramesh, his question is an example of trading and sales. In fact, treasuries of all the banks are known as trading and sales under Basel. So if you talk about a treasury of a bank where there will be wholesale money coming in and going out, or buying and selling of government securities or bonds happens, Ramesh, that will be an example of the trading and sales. Okay, Murli has a question for earlier slide which I had missed out. The difference between building societies and credit unions. Murli, building societies typically, that is in UK, focus mainly in mortgage lending. They give home loans and they accept deposits. So both of them could be for longer period of time. But a credit union is like a cooperative society in India. Remember, in India we have got two categories, cooperative bank and a cooperative society. A credit union is like a cooperative society. It's not a formal bank, but its role is to accept a deposit from its members and lend money only to its members. So credit unions will be like the cooperative credit societies which operate in the Indian scenario. Okay, now we have discussed the four business banking line. Now let's understand, why do we need to have these banks supervised? And of course in this session there are a couple of people from the central banks, especially from Sudan. So they'll be knowing, but I'll repeat for others, that why the banks are supervised. Now before we understand why the banks are supervised, we need to understand the role of the supervisor. And that's where what I have on the slide, these 4 bullet points are explaining us what is the role of the supervisor. And we already said earlier that you can have Reserve Bank of India as a supervisor, or maybe the Federal Reserve System is a supervisor in United States, or the HKMA is the supervisor in Hong Kong. The role of a supervisor is having at least these 4 objectives. So supervisory objectives will include maintaining financial stability in a country, promoting economic growth in a country, protecting interest of the depositors, and 4th is prevent financial crime in that particular country. So when we talk about financial stability means that there should not be inflation, there should not be very high price rise, there should be a stability and continuous growth. And since we said earlier also that the banks provide fuel to the economy, if you provide more fuel, there's going to be more fire. And if there is less fuel, there's going to be less fire. So if you want to increase the speed of the economy, the growth in the economy, then you want to provide more fuel. The banks are the channels through which the fuel goes to the economy. And if you control the money supply, I'm talking about fuel which is actually money supply, if you control the money supply, you will be in a position to control the manner in which your economy moves. So it's like controlling your car. Press the accelerator, it moves forward very fast, and depress it, it will become slower. So in a similar manner, the supervisor, for meeting their supervisory objectives, will be utilizing the banks for the purposes of maintaining financial stability. Now what is financial stability? As I said, not much of inflation, but at the same time, the people's trust in the economy should be maintained. If a bank becomes defaulter, if a bank becomes bankrupt, people will lose faith in that country's banking system. So it is the role of the supervisor to ensure that the banks do not cause any risk to the supervisory objectives. Failure of a bank causes the problem in stability of the financial system, and therefore supervisors supervise the banks to identify, is there any bank in my regime which will cause a problem to the financial stability? And to understand this, they will analyze and supervise the bank, because if the bank fails, the financial stability of the country gets affected, the depositors get affected, and the faith of the people, the trust of the people in the banking system goes down, creating a problem for the economic growth. Then, as I said, protecting the interest of the depositors is also an important task of the supervisor. So they will supervise the banks because they are major deposit acceptors in an economy. And in many places you will find that money laundering and financing of terrorism may happen by using the banking system. So the supervisor's role is to ensure that financial crimes do not happen. And since all these four objectives are connected with a commercial bank, they would use the commercial bank's supervision tool to ensure that all these four objectives are met with. So these are the four objectives. They will supervise the bank to ensure that none of these objectives are affected by the banks in their regime, and to ensure that they will supervise the concerned banks. Are we having any questions on why the banks are supervised now? Great. So let me move to the next point. Now let me explain very briefly, not in very detail, how the banks are supervised. Now the banks are basically categorized. This is the older method called camel. They are categorized by the supervisor. And one of the older categorization method is the camel. So the supervisor will look at the quality of the capital, the quality of the assets, that is the loans and investments of the bank, the quality of the management of the bank, the earnings of the bank, and the liabilities of what the bank has. So these are the typical parameters, 5 parameters. CAMEL is camel. In some countries like USA, they also had camels, S added to it, and that last S was the sensitivity to market risk. Some countries like UK have got camel, BCOM, wherein they add the business, the organizations, the market risk, and the control. So depending on the country, they may use the rating, but using the camel rating is the older methodology. The newer methodology of supervising a bank is to categorize them on the basis of risk-based supervision. In a risk-based supervision, the banking supervisor, like the Fed or the Office of the Controller of Currency, or somebody like the Financial Conduct Authority in UK or the Reserve Bank of India, will analyze the risk created by the bank to the entire system, entire financial system, and on the basis of risk of each of the banks, they will analyze whether the bank will cause a problem to the banking system or not. Now how do they identify this, that whether the bank is causing the risk or not? For that, they will use two main tools. One is on-site supervision, and the second one is the off-site surveillance. In on-site supervision, the supervisor will visit the banks and conduct an on-site audit. And in off-site surveillance, which popularly those in IT companies will call this as regulatory reporting, there is a continuous reporting done by the banks to respective supervisors. And in some countries like USA, there may be more than one supervisor involved. So under off-site surveillance, the banks are required to regularly report to the supervisor all the activities which they carry out. So this is how the banks are supervised in the banking system. Now I'll come to some of the important regulatory ratios. We'll not go into detail. I have already crossed my time limit. So important regulatory ratios, which we will be discussing in detail at a later point in our subsequent webinars, include the cash reserve ratio, the CRR. We can also have the statutory liquidity ratio, the SLR. Then many countries also use the credit deposit ratio, the CD ratio, that is how much is the loan given. Credit is the loan given and deposits is the deposits accepted, the CD ratio. Then we can have the capital adequacy ratio, CAR, or some countries call it as the capital to risk weighted assets ratio, CRAR. Then we will have under Basel III Accord the liquidity coverage ratios and the net stable funding ratios. Now I will not dive deeper into these ratios at this point of time. In our subsequent webinar, as I promised, we will be covering these ratios in detail. So we will have a webinar only on the banking related ratios. Now coming to the last point is the concept of the CRR, SLR and how they are used. So example, I am taking an example from the Reserve Bank of India. Here we have got the reserve ratios like CRR defined presently in India at 4% and the statutory liquidity ratio defined at 22%. We also have the policy rates given by the regulators, and the policy rates will be defined by the base rates, that is the bank rate, as well as the repo and the reverse repo rates. So this is an example of the cash reserve ratio. Now cash reserve ratio is an amount a bank is required to deposit with the central bank. So depending on the banking regulation, banks are required to maintain with the central bank an average cash balance. The amount of this average cash balance which has to be deposited is not to be less than the prescribed percentage of the total demand and time liabilities of that particular bank. And as we saw on the last slide, that was 4% in India. The central banks do not pay any interest on this balance which is kept with the central bank. So this is one example from India, that is the cash reserve ratio. A lot of cash to be deposited, a certain percentage of cash to be deposited with the central bank. The second point is the statutory liquidity ratio, SLR. And in SLR, the banks are required to invest in either deposits with other banks or in gold or in the investment, approved investment, GSEC investments. The concept here again is to take out money from the banks so that they are not able to lend it. Let me briefly tell you the objectives of SLR and CRR. The objective of SLR and cash reserve ratio is to control the amount of money supply flowing in or out of the economy. The moment you increase the SLR or the cash reserve ratio, either of these, the money available in the economy will get reduced, and the moment you reduce the CRR or the SLR, the money available in the economy would increase. So depending on whether there is inflation or deflation in the economy, the central bank may increase or decrease the SLRs and the CRRs. Similarly, the banks also control interest rates on a very broad scale, and this is one example from India where the Reserve Bank of India governs the bank rate, the repo rate, the reverse repo rate and the marginal standing facility rates. Any increase or decrease in rates can cause increase or decrease in the interest rates across the economy, and with this increase and decrease in the rates, the money supply available in the economy can increase or decrease. So please remember that the basic objective of the CRR, the SLR and the different bank rates which you are seeing on the screen now is to control the supply of money available in the economy. The moment you increase any of these interest rates like repo rates or reverse repo rates, the interest rates in the economy will rise. The money would then become expensive, and therefore people would start spending less money. That is the objective of using the base or the policy rates, and that also is the objective of using the CRRs and the SLRs. Now, do we have any questions on these two concepts which we talked about, the CRR, SLR and the policy rates? Now I am moving to the last slide of our session today, and that is briefly talking about, very briefly, because we'll have a detailed discussion maybe at a later point of time, briefly talking about the fund based and non-fund based products. When we have got fund based products, the bank will be actually lending money to the customers. So examples of fund-based products could be mortgages or home loans or car loans. And examples of non-fund-based products, in that case the bank is not lending any money to anyone. So examples of non-fund-based products can be letters of credit or a bank guarantee. So I will now summarize what we discussed till this point. What we discussed today is we started with why do we need banks. Then we took this next point of different types of banks. Then we looked at functions of the commercial banks. We talked about 8 different business banking lines. We talked about this point as to why banks are supervised and how banks are supervised. We also talked about a couple of important regulatory ratios, and now we are on this slide where we are talking about the banking products. Now going forward, this was the first part in our discussion. Going forward, in near future, we will be having small 1-hour webinars on risk management in banking, corporate banking, retail banking, covering various areas in banking one by one. So I would like now to thank all of you for participating in this session. If you have any question at this point, please go ahead and ask the question, and then we'll call it a day. So do you have any questions before we call it a day and close? So now let me thank all of you for participating in the session. Thanks a lot and have a nice remaining day.